Hello everyone, welcome to Fundamental Analysis. My name is Varun Kapoor and I do appreciate you watching this channel. If you do like the content that you see today, then please do remember to subscribe and to like this video. It'll give me immense amount of encouragement to keep creating more content. Up today, Sage Group, it's a UK-based provider of accountancy and HR software packages. It's a name that I've been adding recently to my portfolio, despite it being near all-time highs. So let's dig in and see what I like about this name and what kind of return a long-term investor may be able to achieve. So let's dig in. So what does Sage Group do? So Sage Group, as I said, is a provider of accountancy and HR software packages. If you guys have heard of names like QuickBooks or Xero, essentially they are competitors of the Sage Group. Xero is a company that is based out of New Zealand. QuickBooks is owned by Intuit, which is a large US-based organization, and Sage Group provides similar services as the other two organizations do. The company has about a market cap of 8 billion pound sterling. Its net debt is about, give or take, zero. That gives it an enterprise value of about 8 billion sterling and an EBITDA of about 450 million, which gives it a valuation of around 20 times EBITDA. So what do I like about Sage Group? Well, Sage Group is a software group. We all love software groups, don't we? It has the benefits of recurring revenue. As we have seen, investors like us, we love recurring revenue because that gives us more defensiveness in the revenue and profitability stream. And about, call it 80 to 90% of Sage revenue is on a recurring nature. That is a real positive. The group has been going on for a long time. It has hundreds of thousands of customers, if not millions of customers, spread across the globe. And people are so used to using Sage software in their organizations that in itself provides a little bit of stickiness to the revenue model, where people once get used to Sage software, they are just not willing to move that easily to a competitor software, and that is a good metric to have. In terms of the risks, so now risks is an interesting story here, and we'll have to actually dig into the history a little bit to understand how this group has developed and why the risks of this group were pretty large in the last couple of years, but they seem to be dissipating now. So if you look at the share price of Sage Group, it was going quite nicely, growing quite nicely till 2016, 2017, and then 2018 hit. And if you look at the share price chart, which I will show you here, the group's share price has basically done a little bit down and up and then down and then back up, and that's because the group had increasing competition from the likes of Intuit, which is QuickBooks, and Xero accounting software packages. The biggest mistake that Sage Group has made over the last couple of years is it was late to the party of converting its software from what is called as a licensed software to a recurring revenue software. So a licensed software is if you go and buy a new laptop, let's say, and it comes with Windows, that software is licensed to you. You don't have to pay Windows or Microsoft again and again for that software. And that's how Sage software was available earlier. You make a one-time payment for the software, and if the client doesn't want to upgrade the software, then you never make any money from that client again. And that, as you can imagine, is an old school way of doing things. Right now, look at Microsoft Word, Microsoft Excel, Microsoft Teams. They are on recurring revenue basis. Adobe is a good example. Adobe products are done on a recurring revenue basis where you have to pay either a monthly or an annual fee. So company was slow out of the blocks, where a lot of the competitors were moving to recurring revenue nature, whereas the company was still stuck in its old ways of charging license fee, and that is just not as robust as recurring revenue nature. The other mistake that the company did in the past was its cloud product was poor compared to the competitors. So a lot of the clients wanted access to the accounting software package from anywhere, working from home, from office, from a different office. The software was only available in what is called as in a single desktop, and that again is an old way of doing things. Right now, all the products, all the technology that we see, it's all seamless, and their product was not seamless. So there was a serious risk of them losing clients because they were behind the curve in terms of technology. And what has the company done since then is the company has invested money in research and development, marketing, sales, to do a few things. Firstly, they have got now a large portion of their revenue comes in the recurring revenue nature. So they have done away with the desktop software that it used to provide to its clients, and it's moved those clients onto a cloud-based architecture, as well as moving them into a recurring revenue nature. So the industry is growing quite robustly. The demand for the product is there, but what we noticed in the last couple of years was that that Sage Group was not a winner. It was QuickBooks and Xero who were basically eating into its market share, into the pie that was there, and the share price of Sage Group suffered, and the company has now seemed to have fixed it. So if you look at the latest results that were announced, I'm recording this on the 21st of November. The results were announced 4 days ago, and finally the group has reached a situation where now it's saying that the historical baggage, if I can use that term, that the company had in terms of behind the curve seems to be abating now, such that the group now expects to start growing on an absolute basis going forward. So it's a long-winded way of saying the risks of this business were really the fact that it was behind the technology curve, and therefore the revenues of the business, the profitability of the business, the market share of the business hasn't really grown in the last few years. But now we have reached a stage where company is confident that it has turned a corner and the revenues will start growing now. And that's a key thesis to my investment in this business, is that from now on we're going to see increasing revenues going forward. Financial analysis for Sage Group. Here you can see the group has grown from 1.5 billion in revenue in 2016 to about 1.9 billion in 2018, and then it's kind of stayed around at 1.9 billion. That's driven by two facts. As I said, the group was not growing, being behind in the technology development, and it had some other divisions, some other subsidiaries, some other lines of business which were considered non-core. So the group has basically been selling it. And here you can see in terms of organic revenue growth, it's not bad, right? It's been growing at 3, 4, 5%. Now it's back to 3%. So it's still been positive. Now, if you compare it to how QuickBooks has grown or how Xero has grown, they have been in a completely different growth environment. These guys have been behind the curve in that respect. But overall, the growth of the business has been positive on a revenue or on an organic basis, which is quite positive. So in terms of EBITDA, you can see 330 million sterling goes up all the way to 514, and then kicks in, as you can see here, what I was explaining about company being behind the curve and losing, market share, and having to invest more in research and development and transferring customers, etc., such that the EBITDA of the group has basically stagnated, or in fact you can say it's kind of gone down from 514 now down to close to 450 million sterling. which is essentially resulted in the EBITDA margin of the group, which was around 27%, has now reduced to around 24% as of the year end 2021. The free cash flow available to the firm has gone from 275 million all the way up to 450 million before the company has realized that they need to spend more in research and development, etc., such that the free cash flow to the firm has kind of gone down all the way to about 340 million sterling. But the key thesis, and we will see this in the projections, is I think the company has now reached a stage where the free cash flow to the firm is going to grow going forward. And in terms of valuation, here you can see enterprise value to EBITDA in 2016. The business was growing nicely at that point of time, and I think company hadn't mentioned the fact that they were behind the curve, and essentially everything was perfect with the group, and you had valuation of 20 to 25 times. And then the scare comes, the valuation completely trades off, goes all the way down to 13 times. And now company has taken a lot of steps to improve its performance. Now we're back to around 20 times. So when you think about valuation for this group, we have come from 20 to 25 times, have gone all the way down to 14, 15 times, and now we're back to 20 times, something to be kept in mind. In terms of leverage, the group has essentially close to zero leverage, which is a positive. When you think in terms of any distress event that may hit the company, we are obviously protected as equity holders, considering there's very limited debt sitting in front of us. So how do we project for this group going forward? Now the key metric here to think about is essentially what's going to happen to EBITDA margin, because we have come from EBITDA margin which is high in the high 20s, 27, 28% EBITDA margin. We have come down all the way to 24% because the company has been investing, as we mentioned. And where is the EBITDA margin going? So in terms of revenue growth, last 5 years, the group has been growing at a compounded annual growth rate of about 6%. Organic growth has also been positive. Company focuses on something called recurring revenue growth, which has also been quite positive. So the group has generally been delivering organic growth, and I've assumed that the group continues to grow at 4 to 5% going forward, which is quite reasonable. Mind you, the industry is growing faster than 4 to 5%, and this is a conservative assumption that the company will continue to lag behind Xero and QuickBooks when it comes to rollout of its products. EBITDA margin, as I said, we have come from a high bar of 27%. We are currently at 24%. The company has spent a lot of money already. The benefits of those are going to come in the near future, and therefore you will see the increasing EBITDA margin profile that we have assumed here. So free cash flow available to the firm has been 78% of EBITDA, and we have assumed it stays at that level going forward. Now free cash flow available for equity holders is around 72% historically, but the company has now repaid almost all of its debt. It used to have debt in the past, it's repaid all of its debt. So now the cash that the firm is generating, majority of that should be available for equity holders, and therefore we have assumed an increasing proportion of that free cash flow going to the equity holders, and therefore you will see certain increases that we have assumed here going forward. So let's see the valuation of this group that we can expect in 5 to 6 years time. Here you can see the free cash flow available for the firm. The valuation is around 23 times. That's the average of the last 5 years. And if you assume that the group grows at the 4 to 5% that we're talking about from now on an organic basis, and achieves the free cash flow profile and the EBITDA profile that we just talked about, the market cap in 5 years time is going to be about 10.6 billion sterling. So that's the first methodology that we use to calculate the value of the group. The second one that we look at is called enterprise value to EBITDA. So EBITDA in many respects is a better metric of profitability than net income, and therefore we focus on EBITDA for this group. The average valuation over the last 5 years has been around the 18 to 19 times, and we assume that the group maintains and stays at that valuation. Mind you, if the group continues to show organic growth, there is a good chance that our assumption of 19 times is a conservative assumption, because the group has come from a higher valuation in the past, and therefore we as value investors, as conservative investors, assume that they stick at 19 times. But I will reiterate that it may be a conservative assumption, especially if the group is able to start delivering the organic growth that it's talking about. So at 19 times EBITDA 5 years down the line, I get a valuation of around equity valuation of around 11.1 billion. So I've got two methodologies that I've used. One of them, which is enterprise value to EBITDA, gives me a valuation of about 11.1 billion in 5 years time. The other one is free cash flow available to the firm, which gives me a valuation of around 10.6 billion. So splitting the difference, I think it is reasonable to assume, as per our assumptions, that the group's market cap in 5 years time is going to be about 10.88 billion pounds. So what does it mean in terms of the IRR that an investor may be able to achieve? Here you can see the entry price for the group. It's the 8.2 billion, which is the existing market cap. And there is a stream of cash that investment essentially buys you, which is called free cash flow available for equity holders. And now that has obviously come down. We assume that going forward, it starts at that low level, the 335 million that you can see. But then as the company shows organic growth, it kind of grows over time in the next 5 years and gives you an enterprise value of, gives you a free cash flow for equity holders approaching 450 million sterling per year. And then the exit valuation, as we talked about, based on the two methodologies that we had, is around the 10.9 billion pounds that you can see here. And that gives you an IRR of close to 10%. So if you look at the IRR that FTSE 100, I was doing this analysis a couple of days ago. So if you look at the last 35 to 40 year chart of FTSE 100, it gives you a all-in return, including dividends reinvested, of about 7.75 or 7.75%. And this investment, I think, now gives you an IRR of 10%, which is north of what the market provides you. So I will reiterate that Sage Group has had issues in the past. They have been behind the technology curve, and some of the other issues I mentioned in terms of competitors doing a better job. But now it seems like we have reached a stage where investment has been made in improving the product, and the group's margin has therefore come down. But I think now we have reached a stage where company has confirmed that next year, as an example, it's going to grow 7 to 8% on an organic basis, and will show an increasing margin profile, and that gives us an IRR of around 10%. So as soon as the results were announced last time, 4 days ago, the results were reasonable, and company made some very positive vibes of how the future look. And therefore, although the share price was approaching all-time highs, I have added further of this name to my portfolio with a 5 to 10 year view. And I think this group should provide a 10% IRR, as we just talked about. So this is a name that I like. That was Sage Group. If you have any questions about my analysis, or if you have anything where you disagree with the analysis I've done, then please reach out to me via YouTube, and I will like to discuss with you and answer any questions that you may have. Until we speak next time, thanks for watching. Bye now.